Tensions between the United States and China have taken another sharp turn. New reports suggest that China could start cutting back on its holdings of U.S. debt, a move aimed at protecting its trade from sudden shocks in currency markets. At the same time, stocks and bonds are once again feeling the pressure. Investors are uneasy, watching closely to see what China might do with its massive stash of U.S. Treasury securities. This isn't just about tariffs anymore. China's response is now reaching into financial influence and soft power tactics. Could China really be offloading U.S. Treasuries at scale? Picture this. Every passing minute, the U.S. racks up over $4 million in debt. Now imagine if its biggest foreign creditor, China, suddenly stepped away. What once seemed unlikely is now becoming reality. China has reportedly dumped $1.7 trillion worth of U.S. Treasury bonds. This came shortly after major American banks like J.P. Morgan and Bank of America were ordered to cut ties with several Chinese companies, including blocking IPO plans in Hong Kong. In just the second quarter of 2025, the U.S. Treasury was forced to borrow an additional $514 billion to fill the gap left by China's exit. The dollar didn't escape unscathed. It fell nearly 9% in value. Investors scrambled toward gold and other safe assets outside the dollar system. That raises a huge question. How long can the U.S. economy stay afloat if China escalates its financial counterattack? Let's unpack that right here. Don't forget to subscribe and turn on notifications so you never miss an update. On March 27, 2025, things got serious inside the top floors of J.P. Morgan and Bank of America. Following a call from Washington, Congress issued an emergency order. Both banks were to immediately withdraw from underwriting the massive IPO of CATL, a Chinese EV battery giant preparing to go public in Hong Kong. The U.S. Department of Defense had labeled CATL a Chinese military-linked company under Section 126 of the National Defense Authorization Act. The warning was clear. Helping CATL raise capital could strengthen China's military, worsen human rights abuses, and give more power to the Communist Party. It was a bold move that showed the U.S. is ready to weaponize global finance to defend strategic interests and Western values. CATL isn't just another company. It aimed to raise over $4 billion, money that would help it expand aggressively and possibly dominate the global EV battery industry. The U.S. sees this space as essential to national security. To policymakers, this wasn't only about profits. It was about controlling the future of key technologies and, by extension, global influence. U.S. officials were also worried about a bigger trend: American banks supporting Chinese tech firms that are gaining ground worldwide. An April 2025 report by the International Institute for Strategic Studies confirmed that China is closing the gap in critical technologies, especially artificial intelligence. One major example: DeepSeek, a Chinese AI firm reportedly rivaling top American models, but offering similar power at far lower costs. That's a strategic threat, not just a business one. Washington acted. J.P. Morgan and Bank of America were told to walk away, even if it meant losing out. Backing out of CATL's IPO didn't just cost future earnings. It also risked access to other major Chinese deals. According to Reuters, the underwriting fee was around 0.2%. But due to the IPO's size, each bank could have earned tens of millions. Even more valuable, building long-term partnerships with China's most influential firms. When the U.S. uses its banking system as a tool for policy, global trust can erode. International investors begin to question whether working with American institutions is safe. This fear was raised by former Treasury Secretary Lawrence Summers during a CNBC interview in April 2025. He warned that aggressive financial and trade tactics could trigger a financial crisis and speed up the economic split between the U.S. and the rest of the world. As many predicted, Beijing acted swiftly, unloading up to $1.7 trillion in U.S. Treasury bonds. This sudden sell-off forced Washington into a scramble, securing over $500 billion in emergency borrowing within just one quarter. But the fallout wasn't limited to balance sheets. It triggered a sharp drop in the U.S. dollar and caused shockwaves across global markets. It's now clear. The U.S. has stepped into a high-stakes financial standoff. But the question is, can America withstand the consequences of its own bold economic strategies? And how will China's powerful response reshape U.S. influence in the global financial system? After Washington forced U.S. banks to pull out of a major Chinese IPO, Beijing retaliated with a decisive move, dumping U.S. government debt at scale. In Q1 2025, China slashed its U.S. Treasury holdings to around $759 billion, the lowest since 2016. This wasn't just a knee-jerk reaction, it was part of a deeper strategy to reduce its exposure to the U.S. dollar. China began channeling funds into gold, BRICS development bonds, and UN-backed assets. This isn't an isolated move. Other countries are also diversifying their reserves, slowly stepping away from dependence on the dollar. This broader de-dollarization plan includes not just selling off U.S. treasuries, but also stockpiling gold and expanding into alternative financial assets. By March 2025, the People's Bank of China increased its gold holdings to 2,292 tons, roughly 6.5% of its total foreign reserves. In just Q1, it added 12.8 tons of gold, continuing a 5-month streak of accumulation. According to the IMF, the dollar's share of global reserves has fallen from 64.7% in 2016 to 57.4% by Q3 2024. China's strategic moves are now directly challenging the dollar's dominance, potentially changing the future structure of global finance. This isn't just about charts and markets. It directly affects everyday Americans. As China backs off U.S. debt, bond yields rise. That makes borrowing more expensive, not just for the government, but for citizens too. Higher yields mean possible tax hikes or spending cuts in crucial areas like education, healthcare, and social services. At the same time, a weakening dollar means pricier imports, leading to inflation and eroding consumer purchasing power, hitting low and middle-income households the hardest. China's move to dump U.S. bonds is more than economic policy. It's a geopolitical statement. It's aimed at weakening U.S. financial dominance and reducing Western influence. This moment calls for swift strategic action from U.S. leaders, because the effects are already rippling far beyond Wall Street. After China's move, global investors followed suit. In Q1 2025, foreign investors sold off about $317 billion in U.S. assets, the biggest wave of liquidation since 2016. Nations like Saudi Arabia, Japan, and Germany have also scaled back their treasury holdings, weakening the dollar's global footing. The U.S. economy hit its lowest point in 16 months by early 2025. Congress's order to divest from Chinese firms damaged already strained U.S.-China financial ties. This dampened foreign interest in U.S. stocks, raised borrowing costs, and added to inflation, all of which are making life more expensive for Americans. To manage deficits, the U.S. Treasury raised its borrowing estimate to a record $514 billion, driving interest rates even higher and slowing growth. Even top U.S. companies like Apple are feeling the strain from new tariffs and rising costs. While the U.S. faces financial headwinds, China is forging a new path, building its own national credit rating agency and internal payment systems to bypass Western control. BRICS nations have launched BRICS Pay, a decentralized payment system that allows member countries to trade using their own currencies, cutting reliance on the U.S. dollar. These moves point to a major global pivot away from Western-led financial systems. While giants like J.P. Morgan and Goldman Sachs still dominate global finance, their lead is shrinking as BRICS and other blocs push forward with alternatives. Will the U.S. adapt to this changing financial landscape or continue relying on old playbooks? One thing's for sure. The decisions made now will shape America's economic standing and global power for decades to come. Make sure to subscribe and turn on notifications so you don't miss any of Deep State's latest reports.